Here we are live. Thank you all for joining us. We're gonna get right into it. The content of this broadcast is going to be concerning the bills of exchange, negotiable instruments, and conditions of acceptance and payments on demand. If you're not familiar with any of those topics, then this would not be a video that may be of interest to you. Um, if you are new to finance and uh, the laws or governing bodies that govern finances, if you're not familiar with any laws or rules or regulations that govern finances, you may want to stick around and subscribe to the channel. And as you can see, we have videos on different topics related to finances. But this channel is definitely geared towards maturing in the field of financing as an individual, not necessarily as a business, but as an individual in your personal finances, uh, building or developing estates. In doing that, we cover some topics concerning trusts. We don't purport to give any type of legal advice. This channel is for adults only. No minors allowed. That would include minors that have reached the age of majority but not have matured in their understanding about finances. One thing we will not do is argue with you as to whether or not the information on this channel presented can be verified, because we will verify the information or show you the sources of verification at, within the channel demonstrations of within the broadcast, whatever the topic is concerning. We do have and present and cite verifiable sources. And so we're not geared to hearsay on this channel. We're geared to providing you with information and the governing rules and regulations that we're aware of, and the bodies of law that govern securities or finances or in equity. Um, we do uh, mention and discuss court cases and how things should be handled for the purposes of you having a full understanding that uh, litigation also plays a part in seeking remedy for any financial claim that you may have. Financial claims would include breach of contract, torts and other claims of discrimination and so forth, defamation and discrimination, identity theft, and any of the like. So why What does that have to do with the bill of exchange? Well, what that has to do with the bill of exchange is this. In my study of the bill of exchange, I noticed something that although the bill of exchange doesn't specifically cite that the enforcement phase of it is essentially um, the rules of procedure that govern courts. Okay. It doesn't specifically say that. However, as I began to read the bills of exchange, I noticed the pattern of the the essential components of giving notice. In the description section of this video, you'll see the phrase notice to agent is notice to principal, and that is a common statement being made in this space because uh, it's like saying if I give you notice, then it's the same as giving notice to everyone in your household, okay, or who all is involved, all right, who all is in authority and have the right or authority to act, okay, similar to the et al attachment of representation. It all represents, I'm representing me and whoever, all right. So if you send a notice to me, then uh, to write it all after my name would mean that you would send notice to me for all the parties involved in a claim, okay, in that particular claim. Uh, and that name would represent the case in the matters, all right? Uh, whatever matters is before the court. So while we're talking about court and we're talking about bills, well, there is a body of governance called the Bills of Exchange that governs uh, contractual agreements that fall under the guidelines of the Bill of Exchange. Most people are not aware that of the Bills of Exchange and have not been taught in any type of school setting the importance of understanding your Bill of Rights and as well as understanding how bills of exchange work. The reason for that is because the banking systems capitalize on people's lack of knowledge of the subject, which is why this content is provided on this channel to help people become more aware of their finances and more legally aware of their rights. Not to give you legal advice, it's just to say, okay, you need to take action on this or that and do this or that. But to let you know that you do have a right to take action, and that if you are disgruntled in a matter, that you should take action because of the consequences of acquiesce is that you suffer whatever loss or damage or injury you incur due to someone else's actions, all right? Now, what we discussing here is the bills of exchange. But as I was looking up this document to download another copy of the bill of exchange. I don't know why it's not in my files, but I was seeking to download bills of exchange and to do a broadcast on that. And this is what I came across. This document. We're going to go ahead and read this because I think it's very relevant to what we are embarking upon in drafting these type of documents. Thank you for joining me. I'm on. Where's the read setting? Hold on. They don't allow me to do that unless I'm in the edit file. Okay. Bills of exchange draft for acceptance bill. Okay. Let's read this and see what it's got to say by it for itself. Now, this thing ain't allow us to read this motherfucker. Hold on. Now, I just got this sucker in the file where I could read it a little while ago. And now, it's on conversion. Hi, if it let us do it. Okay, let's see if it allows us to do that. Okay. Read aloud. Oh,
the Bill of Exchange, Draft, or Acceptance Bill. Cambia, Latin lettera di cambio or di pagamento, Italian, lettera de change, French.
Wechselbrief, German. Modern, der Wechsel, die Tratte, Wisselbrief, Dutch.
A simple definition. The Bill of Exchange or lettera de change, later known as the Acceptance Bill and the Draft, was simply an informal letter by which one merchant ordered his agent banker in some other city to make payment on his behalf to another merchant in that distant city. Note that it is an informal command to pay, involving principals and agents. It is not a promise to make payment by a formal contract, as was the bond, the letter obligatory, and the promissory note. Basically unchanged from the 14th to the 18th centuries, the Bill of Exchange was a dual-functioning international banking instrument that involved a loan of funds in one city and the transfer or remittance of funds from that city to a city in some foreign country. The fund.
Now, they're telling you what it began as, but it's all right. Note that it is an informal command to pay. That's what a bill of exchange is, okay? A loan as an acceptance bill. And the draft was simply an informal letter by which one merchant ordered his agent banker in some other city to make payment on his behalf to another merchant in that distant city. I would take some note of that. The letter that changed. It's the letter they used to change shit around. Later known as acceptance bill. You have to accept it. Accept the bill. And the draft was simply an informal letter by which one merchant ordered his agent in some other city to make payment on his behalf. to another merchant. Are y'all paying attention to that? It's an informal command to pay involving principals and agents. Well, how are they involved? It is not a promise to make payment by a formal contract, as was the bond. As was what bond? The letter of obligatory and the promissory note. And okay, so what is the letter of obligatory and the promissory note? Basically, unchanged from the 14th to the 18th century, the Bill of Exchange was dual functioning international banking instruments that involved a loan of funds in one city and the transfer or remittance of funds from that city to a city in some foreign country. The funds lent through this bill were to be repaid at some specific later date in that foreign city, in the foreign currency of that city. A loan made in country A, domestic currency, and repaid in country B, currency. Thus, obviated the necessity of shipping species and bullion between countries, except when a country trade was not in balance. The Bill of Exchange, as a credit and transfer instrument, required four parties, two principals, and two agents in two cities, using two different currencies as follows. The first principal in City A, the deliverer, lends money in A's domestic currency to the second principal, the taker, by buying from him a cambium or bill of exchange drawn upon the taker's agent in City B, and the payer or draw E. The bill is made payable in the local currency of City B at 1 to 3 months usance to the deliverer's agent there, the payee. After collecting the bill, the payee normally purchased a second bill or a recambion and be drawn upon some merchant banker in A and made payable at usance to the deliverer or his agent there. The amount of money that the deliverer received from the recambient was normally larger than the original sum delivered or lent. His profit was produced by a spread between by a spread on the exchange. Produced by a spread, okay? His profit was produced by a spread on the exchange rates between the two cities. In essence, the exchange rates on both bills were raised above the mint par in favor of the lender. This can be demonstrated in the two following examples of bills of exchange transactions from late 14th and 17th centuries. Example 1, Brugs in Barcelona in 1939 or in 1399 through 1400s. This first example involves a cambion drawn in Brugs, Flanders, upon a bank in Barcelona, Catalonia, and a recambium drawn in Barcelona upon a Brugs bank to remit the funds to the original lender. The cambium drawn upon Barcelona on 12 December 1399. Oh, what the hell is going on here? Okay. Oh, crap. Okay. This doggone thing. After collecting the bill, the payee normally purchased the second bill or a recambient. Okay, we read that. The amount of money that the deliverer received from the recambient was normally larger than the original sum delivered. Okay. This can be demonstrated in the two following examples of bills of exchange transactions from late 14th and 17th centuries. Example books in Barcelona in 1399 to 1400s. This first example involves a cambion drawn. Okay. And a recambion drawn in Barcelona. Okay, the cambion drawn upon Barcelona on 12 December 1399. Normandy Dio Amen de okay, Diciembre. Okay. Now they got the shit in some other kind of language. I don't know what the hell. So on the back, okay, it said in translation from the Italian, in the name of God, Amen. Pay at issuance by this first letter of exchange to Domenico at, all right. Giovanni Orlani and Piotr on the back. All right. Source: Raymond DeRuber, Money, Banking, and Credit in Midwall, Brooks, Cambridge, Massachusetts. The Britannic Archives Department of Recovery and Drawn upon Gloves of 1400. In the name of God, Amen. 12th of February. Pay at issuance by this first letter of exchange to, all right, for the value received here from Domenico Sensei, charge this amount to our account. God be with you. accepted letters on the back, explanations at its issuance, the period of time from the date the bill was drawn to its maturity, the date on which it was to be collected from northern European cities to Italian cities. Issuance usage was customarily 2 months from date from those northern cities to Barcelona, 1 month from site or date it was received and accepted. From London to Bruges or later Amsterdam, it was 1 month from the date of the bill. Bills could also be drawn for half, double, and triple usage. Equal shield with the symbol. Here, it was not the famous French gold coin, but rather a Flemish money of account or system of reckoning equal to 22 current Flemish and silver pence. Money of accounts. Both Flanders and Barcelona then used the almost universal system of money of account, by which £1 of money is shilling, and each shilling 12 pence. Okay, the first letter of exchange to ensure the transaction against theft, loss, or fraud. Several bills, each numbered consecutively, would be issued. This bill was thus the first to be issued, and if it arrived safely, it would be the one redeemed, thus canceling the subsequent bills. The merchant bankers transacting the bills. The cambium, the initial bill of exchange. The deliverer or remitter. Who, okay, Jacopo Gascio in Bruges, who lends or delivers 600 excuse worth one. I don't know what that means. Flemish each, grout, Flemish each. The total value equals 600 times and this sum is lent to. All right, it's lent to this person. Okay, in Bruges by buying a bill of exchange from them drawn on Barcelona. The taker or drawer, prenditor. Okay, ain't gonna even try to pronounce that. In Bruges, who thus borrowed the 600 by selling the bill of exchange to. They draw this bill upon Francisco in Barcelona, presumably the Benie's company maintained funds on deposit with the Francisco de Pronto Co. Bank in Barcelona, and thus it in effect. All right. The Orlandini Benizi company, by this bill of exchange, is selling a claim to this foreign bank balance, a claim to its funds on deposit there. Okay, and the company would use these borrowed funds to purchase Flemish woolens, which they would ship for sale to Barcelona, depositing the proceeds from the sale in its bank account. And a payer or drawee Or, okay, okay, the person who accepts, shit. All right. The taker, the deliverer. Okay, they have it all showing you all the positions being played here. You got the deliverer, the taker, the payer, and the payee. Deliverer on the initial cambion who presents the bill for acceptance and then collects the bill on its maturity. Okay. Calculation of the rate of interest or profit on the bill. The interest or profit was included within the exchange rates. Okay. So the interest is understood uh, in this exchange uh, that the interest is calculated on the exchange rate of the currency that's being utilized. Assume that the actual rate of exchange on the Flemish and the Barcelona currency was midway between the two rates quoted in these bills. What I am assuming and drawing from this demonstration is that um, the exchange that was made here was made specifically because of the currency that was being used to process this deal was offered at a different rate of exchange. And so, uh, for example, by the U.S. currency being uh, more valuable, more valuable uh, than the exchange into another currency, that person would then end up with more money. That's the understanding that I'm getting. Okay. Once the currency exchanged over. Um, and so you have these actors. Assume that the actual rate of exchange on the Flemish and Barcelona currency was midway between the two rates. Okay. The profit on the first bill would be, uh, what are they showing? 312 pounds or whatever. And the profit on the second bill would be 625 écus. I don't know what that is. All right, the total profit on the two bills was thus $12. Okay, 12 pounds or whatever this is. Okay. Which is equal to $25,000, I guess, in U.S. currency as calculated above. On both bills, the exchange rate has been artificially raised in favor of the lender, who would otherwise not deliver or lend money by buying bills. While such an increase in the exchange rate is quite clear on the first bill, from tens to tens, okay, well, and how it is the second rate higher, how can simply how this can they be higher? Simply because in the second bill, the Barcelona's currency has been divided by the exchange rate to obtain the required number of Flemish SQs to be repaid, while in the first bill, the SQs were multiplied by the exchange rate to obtain the required number of Barcelonian pounds. Thus, the exchange rate is higher than the mint par. In the second bill, in the same sense that 1/3 is larger than 1/4. In all bilateral international bills of exchange transactions, one country's currency is taken to be the head of the exchange, the fixed monetary unit by which the other currency is quoted in variable amounts. In this case, Flanders is the head of the exchange, and the Flemish SQ is quoted as being worth so many shillings and pence of Barcelonia. When the money market is in equilibrium, the exchange rate for bills is at U cents, will be higher in the city that serves as the head of the exchange than the other. Okay, the difference in the two rates represents the positive rate of interest for that period of usage. This return was not, however, be determined and fixed in actual bills of exchange transactions, and thus, strictly speaking, it was profit and not interest. Hence, bills of exchange escaped the church's usury ban. The return was uncertain because before the second bill or recambium was drawn, the exchange rates might change adversely as a result of any combination of factors. A change in either country's mint par by coinage, debasement, or reinforcement, a change in the official or market evaluations of gold and silver, changes in either country's trade or overall balance of payments, speculative buying and selling of bills in the money markets, or indeed changes in the market rate of interest. Bankers did lose, but they gained more than they lost. NB, the bill of exchange as a transfer instrument. The examples given above assume that the bill of exchange was utilized essentially as a credit instrument to finance international trade. Excuse me. And that its transfer functions were merely to facilitate payment. But the bill of exchange could also be used primarily as a transfer instrument to effect a payment owing in a foreign city. In this instance, the original roles of deliverer and taker as lender and borrower, respectively, will be reversed. Okay? Pay attention. As lender and borrower, respectively, will be reversed, so that the delivery became the borrower and the taker became the lender or creditor. Let us reconstruct the first Columbian of 1399 using the same principles and agents to see how this would work. The deliverer, the Thor, Indorse, who is now the remitter, owes the sum of 312 whatever Barcelonese to some creditor in Barcelona, whose banking agent there in Domenico, possibly, okay, the payee, possibly company partners or other family members in Barcelona have borrowed this sum, or Domenico, or possibly has imported goods from Barcelona and Brugs and now must arrange payment for them. So Dacio now buys a bill of exchange from the taker all right, at the agreed upon exchange rate. The company draw their bill of exchange upon their banking agent in Barcelona, Barcelona, the payer who is in Francisco, which is ordered to make payment to the aforementioned and stipulated payee in Barcelona, thus on the redemption or payment date stipulated in the bill as the designated payer, do redeem this bill and make payment for the sum of into the bank account of the payee. And so in this fashion, the deliverer has honored his debt to his Catalan creditor in Barcelona. Obviously, in this case, there is no need for a recount. At users, pay this, our first bill of exchange, our second and third not being paid, pay unto Mr. James Twyford, or order the sum of $155.5 per day, dollar per dollar, for value received here of Captain William Fisher, and place it to account as per advice. So I see here somebody say they accepted it. All right. Source Joan Century Economic Documents. 17th Century Economic Documents. Okay, explanations or order payable to the holder, bearer, or possibly the agent or creditor of the payee. Bills of exchange had now become negotiable credit instruments transferable by the endorsement. The merchants and merchant bankers, the deliverer, Captain William Fisher, who lent to Parker Holditch by buying from him a bill of exchange drawn on in Amsterdam And the taker, brokerage, Parker, holders, and who thus borrows the said 23 pounds or whatever the hell by selling a bill of exchange drawn on Amsterdam. He might thus have used the borrowed funds to purchase Italian textiles, goods received from the Turkey trade, for export to Amsterdam. The payer, John Brokerage in Amsterdam, who accepted the bill and thus agreed to pay it to the designated payee, James Twyford, at usance on the date of maturity, may also have acted as the commercial agent for the taker. Mm. By arranging for the sale of the goods imported from Leghorn, and again he would have used some of the proceeds to redeem the bill. The payee, James Twyford, in Amsterdam, who received the bill in the mails from the deliverer, William Fisher, presents it to the payer for acceptance, and then collects the sum of 100 rix dollars on the date of maturity. However, might have sold the bill at discount sometime before its maturity. In that case, the holder of the bill would collect it on maturity. Uh-huh. Construct a return bill or recambient drawn on Leghorn in order to remit the funds collected in Amsterdam to the original deliverer, William Fisher. In Leghorn, assumed that the rate of exchange quoted in Amsterdam. Note that the Rix dollar here serves as the head of the exchange. The amount to be redeemed on the recambient would thus have been 100 times that. If the two bills took a total of 4 months to be transacted, the per annum rate of return would have been 20, 12 4 times. Oh no. Modern accepting banking accept pre-diet. Wow. An accepted bill is simply the more modern form of the bill of exchange in financing international trade with a few differences. The accepted bill is essentially the same as earlier forms of bill of exchange in that a merchant acting as a principal mm, a merchant acting as a principal, huh? Orders or commands his agent banker to make a payment on his behalf to another specified merchant in another city. Note once more than uh, who was the payee in the original cambium? He lends the proceeds of the cambium, okay, by buying from him a bill of an exchange drawn upon Brooks. He is thereby able to remit these. What the hell is going on? All right, we got the taker, the payee. Okay, calculation of rate of interest or profit on the bill. The interest or profit was included within the exchange rates, and in this example, cambium and recambium, the original deliverer has made a profit. Okay. Hmm. It said the deliverer became the borrower and the taker became the lender. Or creditor. Let us reconstruct the first cambio. And remember the oldest son after 12 was one to some creditor. And there is a Dominican, okay. Possibly company partners and family members, okay. Have borrowed the sum from or possibly has imported goods from Barcelona and now must arrange payment for them. So, Garcio now buys a bill of exchange from the taker for the sum of $600 at the agreed upon exchange rate and okay, draw their bill of exchange upon their banking agent in Barcelona, the payer who is in Francisco, which is ordered to make payment to the aforementioned and stipulated payee. Thus, on the redemption or payment date stipulated in the bill as the designated payer, do redeem this bill and make payment for the sum of into the bank account of payee. And so, in this fashion, the deliverer has honored his debt to his creditor obligably. In this case, there is no need for recambio. 2nd of October. Okay, at issuance, pay this our first bill of exchange, our second and third not being paid, pay unto Mr. James Crawford. Okay, we got to that. Order payable to the holder, bearer, or possible to the agent or creditor of the payee. Bills of exchange had now become negotiable credit instruments transferable by endorsement. Okay, so now we up to the times is how the bill of exchange is operating. Merchants and merchant bankers, the deliverer, okay, who lent to Holdage by buying from him a bill of exchange drawn on Amsterdam. The taker, who thus borrows the said money by selling a bill of exchange drawn on Amsterdam, he might thus have used the borrowed funds to purchase Italian textiles. All right, we read that. The payer, John, in Amsterdam, who accepted the bill and thus agreed to pay it to the designated payee at usage on the date of maturity, may also have acted as the commercial agent for the taker by arranging for the sale of the goods imported from Leghorn, and again, he would have used some of the proceeds to redeem the bill. The payee in Amsterdam, who receives the bill in the mail from the deliverer, William Fisher, presents it to the payer for acceptance and then collects the sum on the date of maturity. However, might have sold the bill at discount sometime before its maturity. In that case, the holder of the bill would collect it on maturity. It's something similar to how tax liens work. You pay a person taxes, and then they have to pay you interest on that money uh, up to a certain amount, depending on what type of work you have to do on the property to get it in up to safe conditions. Um, if it has to be brought up to a certain standard to not be deemed as a derelict, uh, then you may also add those costs, forward those costs to the on record owner, and if they have breached the time to recover the property, then you can proceed with the deed, filing to an adverse action to get the deed of record on that property, by way of the tax lien. So that's similar in nature, but from what I'm looking at, however, this memorandum seems to be purposely and intentionally confusing. I would say because even what I've gathered out of it seems to be it was like pulling teeth to extract that understanding, that much understanding out of it. Acceptance bill is simply the more modern form of the bill of exchange in financing international trade with a few differences. The acceptance bill is essentially the same as earlier forms of the bill of exchange in that a merchant acting as a principal. That's a key point right there. A merchant acting as a principal. All right. Okay. What is the merchant doing? The merchant is acting as a principal. We want to keep that in mind. Okay. The orders a command or commands his agent banker to make a payment on his behalf to another. All right. Okay. Now, if we following along, who is who is ordering who to do what? Okay. And so the merchant is now acting on your behalf because it says they're acting as a principal. Okay. They're acting for themselves as a principal. Okay. And they go forth and they order or command uh, his agent or banker to make a payment on his behalf to another. And so they order money, all right, and say, I need to have money available for my constituents. I got people that signed up with my bank that need access to money, and so I need you to order some money. Okay, specified merchant, all right, on his behalf. That specified merchant is whoever he chose to do business with. Get that money, all right. But they're getting it from the federal uh, United States Treasury, all right. And and that's a specified merchant in another city. Note once, okay, now I will take note that each one of these entities, okay, the main centralized banks is not everywhere. And so I noticed that it's only specific banks that do certain things. So um, it's like a zoning. All right, this money going over here, and so in order for you to say you sent this to, you know, Wave to somewhere, you would need to make a transaction to individual parties that don't seem associated with each other. And that's, my understanding of it, that the purpose of sending the purchase order or whatever you want to call it, or the order uh, commands his agent, banker, or make a payment, all right? And then, okay, the essential difference is that the bill involves the loan of commodities, grain, lumber, wine, rather than of money. The acceptance bill is therefore a form of straight sales credit. The four parties in the acceptance bill, therefore, are the seller and the buyer. of the commodities in City A, Transaction City, and their two banking agents abroad who arrange payment or redemption of the bill. Uh, the acceptor or payer of the bill as the payee. Example, for the merchant instructs his commercial agent in Danzig to buy a shipload of grain and to arrange payment for that grain by drawing an acceptance bill. Okay, bank ordering that bank to pay the designated merchant or bank in Amsterdam at some future date, usually within 3 months. The agent buyer in Danzig is thus borrowing the grain from the grain seller who is selling it on credit. Having received the acceptance bill from the border merchant, the buyer's shipping agent in Danzig gives the bill to the designated merchant. The merchant sends a copy of his instructions to his Amsterdam bank, and bank, meanwhile, the Danzig grain merchant sends the bill he has received to his own bank in Amsterdam or to his merchant agent there. And that agent or bank, B, acting for the Danzig grain seller, takes the bill to the bank, Bank A, as the agent for the borrowed merchant, and then Bank A receives the bill and writes on the back, "We accept," meaning that it promises to honor bill and make full payment on the date of maturity, redemption date. Hence, the terms acceptance banking. And that bank is called an acceptance banking or an acceptance bank. That bank might agree to make payment cash the bill ahead of time, but obviously, as indicated earlier, at discount, the Amsterdam Accepted Bank has thus agreed to extend financial credit to the borrower merchant. If that borrower merchant maintains an account there, a credit balance in that bank, he can simply oh shit. Now, okay. Instruct that bank to recover both its credit advance. Okay, let's start over. If that borrower merchant maintains an account there, a credit balance in that bank, he can simply instruct that bank to recover both its credit advance and its banking costs, which might also include shipping and insurance premiums, and its profits by a simple account transfer debiting the borrower merchant's account. If the borrower merchant does not have an Amsterdam bank account, then the Amsterdam Acceptance Bank will draw a second bill upon the borrower bank, acting for the borrower merchant, for the sum advanced plus all costs and bank profit. A diagram of the four bills of exchange functions served by a merchant bank. Examples of bills of exchange transactions in the form of a cambion and a recambion involving Italian merchant bankers in Bruges, Flanders, and Barcelona. Catalonia. Okay, cambion. That is not what I want. Okay. Because I believe this is more so an example of an international bill of exchange, and this document delves into the bills of exchange and promissory notes, and we'll get into that on another broadcast. Thank you all for joining me.